Welcome to Agency Acquisitions and Exits. I'm your host, Peter Lang. Today, we start a multi-episode deep dive with my CFO, Peter Baldwin. We've worked hand in hand on transactions since 2022. He's also a vital part of what I do in regards to advisory, and he works with me side by side and many of the founders that I have supported as a board advisor and as a mentor for these many, many years. Now, the big question that everyone has, especially when talking with a deal maker like me and a CFO like Peter, is creative financing. So we put together this series to unpack and reveal creative financing for programmatic M&A. And this is episode 1. So let's dive in. Peter Baldwin, I want to start here because this keeps coming up. I had a conversation earlier today with Ami of Multifunding, and what he shared lines up with what we've been seeing across the board in regards to leverage buyouts of these small businesses. Default rates in marketing agencies, there's words that it's ticking up, going to a point to where they're being more scrutinized by prospective lenders, and therefore it's going to get tighter. And some have even flagged these lenders and put them on the watch list because of these default rates. And what that means for the listener practically is that this easy way to buy companies through the SBA-backed program is not going to be as easy moving forward. So if you're someone who's entering the M&A strategy and you think, hey, I'll just go buy a business using an SBA-backed loan and that's going to fund this deal, well, that strategy is breaking. And I think that's a good thing. And because I've been working with you, what is it, since 2022 now?
Mm-hmm.
We know that there's many other ways to get deals done, and that's the focus point of our episode today. It's creative deal structures, how deals actually get funded, especially given the climate that we're in. So, Peter, let's start here. Why do most entrepreneurs, founders fundamentally misunderstand how acquisitions are funded?
I think the misunderstanding comes from people importing mental models or preconceived notions from other forms of financing. In my experience, the most common debt-related transaction for your typical individual who may be thinking about M&A for the first time is real estate, right? They've bought a home with a mortgage. So they think about it in terms of kind of the conventional lending model, right? I have a stable asset that has a clear collateral value, and I am going to bring that asset to the bank and say, hey, I want this asset and please lend against it. And so, the typical way that works is, the kind of the old formula for real estate is 20% down, the asset is the collateral. It's a typically appreciating market. So the bank is a fairly comfortable, stable source of conservative capital.
Sensible and reliable, and it's what our economy's been built on.
Right. Home ownership and lending for home ownership is the bedrock of the American economy. And so that is the most common mental model people have to bring to a business transaction where they're looking at something similar. They're buying an asset. The asset has a value they ascribe to it. But at some point, that model starts to break down, right? I mean, if you think about the comparative in the small business market to real estate financing, it's the SBA loan, right? The 7A loan. That is longer term, conservative amortization, moderate interest rate debt product. There's a whole bunch of hoop jumping. It's a conservative lending model. The problem is that in many transactions, that's not appropriate, frankly.
Yeah. It's a combination of wonderful and terrible. It's wonderful that the U.S. has a program like that's pretty bipartisan, but it's also terrible because it's a leverage buyout on businesses often that never have this much debt on.
Yeah, and if you look at, the recent performance, as you alluded to, in the SBA lending market, this particular NAICS code, right, for marketing and advertising agencies has seen an uptick in underperformance, if you will, in defaults, right, where default rates have almost doubled versus their historical averages. I think they're about 1.4% now versus an historical of 0.6 to 0.8% on SBA loans. And on top of that, the SBA lending portfolio has been underperforming as a whole ever since it was used as an economic recovery engine, first out of the COVID period where they did all the EIDL loans. And second, you've seen some of the same things happen in the wake of the California wildfires, where they had SBA lending to try to kind of rescue businesses in that space as well. And so SBA's portfolio is already stressed, and they're looking at this harder. And they're specifically looking at industry sectors that are spiking in default rates and underperformances, pre-default loans, right, where you've missed a couple of payments or there's early indications of default. All these things are getting pushed back on by the SBA, and so there's a need to find a less stringent lending product, or alternately to find creative capital structures to structure a deal.
Yep. And that's to bookend the SBA. Lenders make money by reselling that paper. And
Yeah.
so that's part of it is the value of that paper on the secondary market.
Maybe it actually makes sense to take a step back and talk about the actual lending market as a whole, right?
Yeah, let's set that stage.
Just like the conventional mortgage market, right? The conventional mortgage market is the product of the federal mortgage buying agencies, right? It is created by a secondary market that is subsidized by the government, which creates an ability for banks to make the initial loan and then clear the loan off their books to allow them to recycle the capital. And they sell that loan into a mortgage buyer, Fannie Mae, Freddie Mac. There's a host of other types of those products. Those are the two best known, right? And a conventional mortgage that fits the formula gets sold into that conduit. It frees up the bank's balance sheet for them to take that cash and lend it again, right? The SBA is the exact same. The SBA is essentially a loan guarantee platform where you can get 75 to 90% of your loan, depending on whether it has export development components to it for the higher percentages. And you can essentially de-risk your balance sheet if you're a lender, a commercial lender, which allows you to recycle that capital. In fact, or 75% of that capital can get redeployed. Well, with the default rates going up, and with the SBA holding the ultimate default risk of the vast majority of the capital deployed in those loans, they're getting conservative. And so that market is tightening.
And I do want to say it's like a perfect storm, which is the SBA also opened up the lending criteria recently and made it more accessible to a variety of different deal structures and founder scenarios. They've now swung the pendulum the other way, and they've tightened it back up in 2026 as of March. And so there's a lot of things that are culminating to, hey, we're going to be very careful about this being a fill out the form, underwriting is easy process, even though the SBA's never been that, but like fundamentally a pretty straightforward lending solution.
Yeah, it has been, it's worth mentioning, right? So the SBA did relaxed its lending standards, right? It tried to make it easier to have more aggressive deal structures, to have standby seller notes that were used to satisfy the equity requirement, at least in part. In fact, it used to be until the most recent changes that you could have a standby seller note that was standby for 2 or 4 years, and that got equity credit for up to half of the down payment required, the 10% equity requirement.
Yeah.
As long as it didn't amortize during the first 2 years of the instrument of the SBA loan. Now, the most recent changes have essentially said that, yeah, you can still use a standby seller note, but it really has to be equity, right? It has to be
after you pay us is another way of saying it.
It can't amortize for the entire duration or period for which the loan is outstanding, which means it's not a standby seller note anymore. It's really, we'll call it
an equity instrument almost.
It is. It's an equity instrument, and it's funny because I've one of
we're going to get to that one. Don't
full well that I like equity instruments as that are creative as a way to get around these sorts of structuring issues, which I presume we're going to talk about.
Breaking the fourth wall. That's what we're talking about. Hopefully, in this episode of our series on this, because that is a very powerful tool. We want to make sure everyone has available to them because it's what you and I like and use frequently.
And especially considering the fact that essentially that's what the SBA is forcing you into anyway at this point. So why
the SBA is forcing creative structures. So the terminology creative financing has existed for a while.
Mm-hmm.
And what we're talking about in a business buying context. So let's make this practical. Because people might be disqualifying themselves too early from participating in this dialogue with us. I've spoken to hundreds of owners who think, hey, if I want to buy $1 million in profit business, well, I don't have 1 million or 2 million in cash sitting in the bank to put down. So I can't do this. And that's what the SBA kind of said. Hey, we show up and we help you do that. And it's a leverage buyout on this business. We're going to put massive amount of debt on a business that never has debt, and you can buy it from the founder.
Right. I
But
mean,
that's
yes,
not
it says
how real,
10% down and we'll finance the rest of it.
and we'll pay that seller 90%. Good deal for the seller because they get to get 90% of that cash and the risk falls on the buyer. But that's not how like real deals get done. The deals I've been involved in, the deals we've done together, the deals that we've advised others on, especially the better ones, they're funded because someone had, the creativity to figure out how to structure a deal appropriate to the risk of the business they're buying. And, that business should be able to support the funding mechanism put in place. The seller is aligned on that objective, and like the risk is distributed appropriately. So like the capital followed the structure, not the other way around. Why do you
Yeah.
think that's like, you come from traditional investment banking. Why do you think that's the case for these entrepreneurs?
Well, what I think is the case for the entrepreneurs, or what do I think that's creative deals are designed
Let's
as
do
they are?
both. Yeah, let's do both.
I think that many entrepreneurs are stuck in the notion that they have to be able to pay, right? And they have to be able to pay up front, a majority of the compensation. And that it's interesting because it's kind of contrary to the mental model they bring to the transaction, right? Which is the real estate model, where you put, in an FHA loan, like 3% down, or in a conventional mortgage, 20% down. And the rest of it is paid over the viable life of the asset or longer. And in an SBA loan, that's very much the same model, right? It's I put 10% down and I have a 10-year term on the loan. The seller gets their capital up front, or at least 90% of it, and they have to roll the balance over time, however we structure it. The creative deal structuring says not the way we should do this at all, right? We need to match the duration of certain portions of the deal compensation structure for the seller to a period of performance or a period of de-risking. You want to link it to the nature of the risk you're trying to tie to the instrument, right? And the duration of that risk. So, for example, oftentimes in a deal, you'll have a holdback period where there is an escrow of a certain portion or a delayed compensation. And in that situation, you're essentially saying, I need 90, 180, 365 days to figure out if there's any bad news or things that you haven't disclosed. They're going to percolate to the top and I'm going to discover. So that's why so many deals are structured that way. When I worked in investment banking, and also when I worked as a private equity CFO, and you see these loose sites on the wall behind me, they are all essentially tied to creative deal structuring, where we had to tie a deal's design to the nature of the risks we were trying to manage. When I worked for private equity roll-up in the med device space, we bought 125 million of revenue across six different portfolio assets in the course of 18 months. And every single one of those had a specific bespoke deal structure that was linked to the specific bespoke risks that we found when our diligence said, here's a thing we have to manage around. All of them included things like deferred compensation, an earnout, or
Equity
an
swaps.
or an equity link instrument, or holdbacks, or there's a slew of prospective customized transaction elements that we used in those to link the nature of what diligence revealed to us about how we wanted to, and about those risks and how we wanted to manage them, with the actual consideration and the capital stack that we installed into that instrument, or into that company rather, and the various instruments in the capital stack at length with our conversation with the seller. That was the process, something we set up over time by identifying those things and being forward with them, with the seller, about here's a risk we want to manage.
Yeah, it's interesting from an investment banking and corporate finance perspective. You're playing with house money. It's not your money. You're in a position.
Yeah.
You're in a role. You're in a job, and you're just doing transactions. In smaller business, if a lot of founders feel like it's the money out of their wallet, out of their pocket, that's being invested into this other business, that's going into another founder's pocket, and so there's a big emotional constraint, limitation, bias around what they feel they personally need in order to be successful in doing M&A. Although M&A exists, as you've described it, at scale, with all of this creativity, because not only is the M&A solving a business problem, the deal structure itself needs to solve the problems that are
Yes.
presented as risks in the business.
Yeah, and the technology, if you will, the capital stack design knowledge and technology that's used in the biggest of deals is appropriate in many of the smallest of deals if you have the same risk profile, right? It is about finding the the intellectual property is easily accessible and customizable, and it's appropriate in situations. I made reference to the deal toys on the wall behind me. The biggest one on that shelf is about $18 billion, and the smallest one on that shelf is less than 2 million. And both of them used an element of a seller note, an element of deferred compensation, an element of uh, various structured elements of the capital stack to divide amongst the constituents who are willing to accept yield and risk at that level of yield and risk.
Well, let's slow down because you and I are going to lose people on our corporate finance shorthand. Let's talk about the capital stack. Let's unpack it for the listener. What matters most in its component parts? Run us through it.
Well, broadly speaking, you can bottom to top or top to bottom. I grew up in restructuring and turnaround and leverage finance. So I started with debt, and I was always taught that's the foundation of your capital stack. And if you think about it,
Bad, terrible, Peter. We're
well,
founders. We start with equity. What are you talking about? Starting with debt.
it's funny because so many founders I know focus on other people's money, right? How do I use OPM to get as much of this done as possible? And then I fill in the gap with my own money, right? Just like when you bought a house, you put 20% down and the other 80% you borrowed. This is the same concept. Same thing with SBA with the 90-10 structure. But debt is the foundation. And this is also because it is what gets paid off first. If you think about if everything goes sideways and who's first in line to get paid, well, it's the mortgage holder in a real estate transaction. It is the SBA lender in an SBA transaction. That is a first lien debt instrument. A senior secured debt instrument is the foundation of the capital stack. It is secured by the most important and valuable assets. In real estate, that's the house and the land. In an SBA loan transaction or in any sort of corporate finance transaction, it's typically you'll see a pledge or a collateral grant, security interest grant on almost all of the assets of the company, and that includes everything from the quick assets, the cash in the bank account, the bank accounts themselves, the accounts receivable, any inventory, any other chattel paper, receivables, things that are owed by the founders to the company, all the way down to the intellectual property or the trademarks or what have you that are owned by the company. And if there's any fixed assets or physical real estate, those are all collateral for the first lien lender. There can also be in a capital stack, various secondary or tertiary liens where you get a second lien piece of paper that is essentially said, if there's anything left over when this first guy gets paid, I'm next on all this with respect to the collateral. Then you have unsecured financing, right? And unsecured financing sits below the senior secured debt and ahead of any of the equity, right? So if you think of I'm building my foundation, I've got my first building block is the secured debt. My next building block is any second lien secured debt, any unsecured debt above that. And then you start to see instruments that are sort of debt equity hybrid instruments.
Which we'll get to. I don't want you to reveal that too soon. Stick to the end with us for
Okay.
that. It's a secret,
And
a well-known secret, but it's still something that's secret in regards to the content we're covering today. So that is the capital stack traditionally,
Mhm.
which then has the problem that we've identified with the SBA. You have banks, lenders, an independent third party who's putting money into the deal, who has so much control over the assets and yet are not involved in the operations.
Mhm.
And this is when creative financing changes that capital stack. So what you're referring to is the traditional one that everyone thinks they need to do. It's I got to go get a loan, I got to go buy something, and then I got to have payments to this until I own it fully and I got the equity then.
That is the hierarchy or recovery waterfall, or however you want to talk about it in traditional structures. Doesn't have to be a third-party bank lender to be a secured instrument. Can be a seller debt that is a secured instrument.
Yep. And
I don't
that's
usually lead with that if I'm advising a buyer, but we can talk about ways in which to do that.
so that's you just gave us a good visual structure of the capital stack in a very debt oriented way. Now, you and I have done some really creative deals together, and we don't think debt first. What is it that we would recommend the listener to think about in regards to debt when we're starting to swap out its component parts for alternative?
Well, debt tends to be, by its nature, unforgiving, right? I mean, there are forgiveness provisions. There are not in the sense that you get that the debt goes away, perhaps, but in the sense that debt has scheduled payments. It has interest rates. You need to make your payments, including your interest payments, whether that's a single amortization payment or what have you. But that scheduling creates burden on a business, right? And if you have a business that is seasonal or is highly exposed to a couple of critical customers or big project based deliverables, like agencies often are, you are in a situation where debt may not be the right instrument. It's certainly not like a, high amortizing short term debt instrument where you got to pay the whole thing off in 3 years. So you start to think about what are other ways that I can give a seller something that feels a little bit like that, where they think I've got a number, right? And this is the one big issue between a traditional common equity instrument of, I'm a shareholder, and a debt instrument for a seller where it's like, I have a number that you owe me.
Yes.
And because, as we all know, as equity holders of our various businesses, equity gets what's left when everyone else gets paid, right? A debt instrument that sits first in line feels like I get paid and then it's everybody else's problem. There are instruments in between those two things that are variable in how they pay out and how they think about the actual payment of amortization payments or a debt pay down, if you will. It doesn't necessarily have to be a scheduled amortization payment, or distributions or other types of contingent consideration, which are not contingent in the total quantum of how much you pay out, but rather in the timing over which they are paid. And you start to think about, how do I design a capital stack that has more of these instruments that are better suited for an agency that isn't, I get this much revenue every month. It is recurring. It is always the same. Like if you're a SaaS business with MRR that is subscription based, that may make sense. But
Or manufacturing, and you have inventory that you can collateralize against and
yeah,
assets.
and we haven't even talked about the nature of individual types of secured debt instruments. Like you can do you can do a cash flow term loan or revolver that is collateralized by the quick assets in the inventory, or you can do an asset-based loan with an asset-based lender that does the same. There's also other types of asset-backed financings like receivables purchase agreements or future receipts purchase agreements, which you may also think of as merchant cash advances. And if anybody's gone through the treadmill of dealing with those, it's something best avoided, in my opinion. But those are all instruments that are unforgiving, right? You owe me $52,000 a week until this instrument is paid off, period.
Yeah. It's a great industry to lend out of.
And you're all, I know
Yeah,
guys in that space,
it's a great space to be.
but they are also, for many people, they are lenders of last resort for businesses that meet the underwriting standards of an SBA loan or a cash flow secured debt instrument, which is why, trying to solve those problems for people, you try to think about, how can I get somebody who I want to borrow money from to take something that is, or maybe it's not even borrow money, but I think it's a seller, right? I want to get them to make their cash flows variable, right? So I'm not bleeding out my eyeballs every week, no matter whether the business collected from that big client or not.
Yeah, it's interesting. Sophisticated buyers and sellers understand the context of M&A and typical transactions. Unsophisticated sellers have wrong expectations. They think some ultra high net worth individual is going to show up with a personal or corporate balance sheet. It's going to pay them a lot of money that's extremely favorable for their retirement. And I mean, this is where agencies get interesting and dangerous, because on paper, an agency might look financially stable, reoccurring revenue, long-term clients, decent margins in the business services category. But when you actually look under the hood, you see client concentration. One client might be 30, 40% of revenue. Just trickle that down, 30, 40, 50% of the profit margin. Delivery might depend on key people, two,
Yeah,
three, the
that's
founder.
founder dependency is often a very big element of that, which is why sales from founders are such a potential challenge. You also have a question of you're going to announce a change of control. Well, that big client may have a veto right on whether their contract gets handed over. I want to digress for a moment. Do you remember when Ryan Reynolds sold Aviation Gin?
Yes.
He posted some pretty hilarious Twitter content, but one of the things he did like 3 days after the transaction closed, he said, posted on Twitter, he's like, my lawyers have just explained to me the concept of an earnout, and apparently I will continue to be working for this company for the next X years, right? And it's so, when people have this perception of, I get a big check and I walk away and it's all done, that just doesn't happen, right? It doesn't
It's
happen.
atypical. Yeah.
It's extremely rare, and
But it
it's
is
usually
but it is pervasive in
it's a belief.
media and online when people talk about exiting.
Yes. Well, in part because they're essentially, this is kind of social media image management, if you will. They're talking about I had an exit and I'm not, and they portray it as I walked away with a giant truck, a flatbed truck full of money and everything is awesome. But usually there's a series of strings and delayed and deferred cash flows and performance obligations. And all of those things are tied by deal structure to how and when they get paid and how and when it is financed. So everything boils down to capital structure drives transaction design and transaction feasibility, right? I don't buy something if I'm not comfortable. I've de-risked it and linked my capital structure in the transaction to all those risk factors that I made mention of before when I talked about things that are identified in due diligence, right? So is that client 30 to 40% of revenue and 50 to 60% of profit? You and I have seen that in a host of agencies, and it's a very common problem. It's something I deal with in my own business. I have one kind of large client who is, not a majority of my business, but a meaningful minority of my business. And, if I were to try to sell that business, any buyer would look at that and say, how do I lock that in? And how tied is it to your continued involvement in the business, Mr. Baldwin?
Yeah. So it's kind of making sure we can bridge the concept. So the one thing that I want a listener to get out of this, I do like how the SBA is incredibly useful because it does teach people who have less experience with debt, because you have tremendous experience with debt, how to manage leverage, amortization, negotiate attractive pricing. Those benefits come with constraints around personal guarantees, debt service coverage ratio requirements, limitations on adding additional debt in the future, reporting requirements.
Yeah. Founder life insurance pledges, you got to pledge your house.
But I like that it does prime people for the seriousness of the journey ahead, although in many respects, this is why this episode's creative financing, not always appropriate for the types of assets being acquired.
Do you know the acronym TANSTAFL?
You said
There
me,
ain't,
like, because I don't know it actually.
there ain't no such thing as a free lunch.
Uh,
So lending is sort of the epitome of TANSTAFL, right?
yeah.
Every bit of freedom comes at a price. So if you want the government guaranteed 25% covered, interest rate subsidized, long amortization period, a high leverage loan with extremely attractive pricing, it comes with a price, collateral, pledge of all the equity of the business, more collateral, a pledge of the equity in your house, right? Second lien on your home behind your mortgage lender. You have to take out an insurance policy on the founder or any key people. And it's any 20% plus shareholder. And they even look at in the capital structure, they'll say, is anybody close to 20%? You can't go like, hey, so-and-so gets 19.9% and they're scot-free. Now the SBA is going to circle back and say, we want that person too, right? All those people are on the hook. Now, it also comes with the compliance requirements you made reference of, right? That's not just the personal guarantees, it's debt service coverage ratio. You've got reporting requirements on the quarterly. You've got to give them copies of your tax returns every year. There are limitations on the additional indebtedness. That additional indebtedness cannot amortize over or in front of the SBA loan. All those things. Oh, and by the way, these loans also get sold in the secondary market to a third party buyer most of the time. So the original lender often, if you've ever seen your mortgage change servicers, well, there you go. It's the same idea. It got sold into a loan portfolio for business loans that got structured into a collateralized debt obligation, which got sliced into tranches, which got sold to hedge funds, who all of them, in order to buy those secured debt instruments. If you've ever seen The Big Short, it's still happening. It happens with every single piece of debt or out there that is similarly situated, right? So you see that with car loans, student loans, mortgage loans, SBA loans, all of them get structured into these derivative instruments, which are further sold on to the secondary and tertiary and quaternary markets. But the problem is when the underlying loans stop to perform at the level of expectation and rates get out of the historical default rate, just like you saw
Yes.
in The Big Short when Steve Carell said, wait, so the the A tranche is going to default at a 20+% rate,
Yeah.
that breaks down, right?
Yes. And
And
that's
now we're not there yet. And we've seen a lot of lending in the marketplace, which has been aggressive, but we're at a point where certainly look at the exogenous political environment. We have a whole lot of economic risk that is not even tied to the sector that is causing conservatism now. Then you also see the uptick in the actual sector specific default rate. And what used to
and
be
never mind that the SBA has collected virtually no fees on 85% of its portfolio over the
SBA is
last
running a
3
loss,
years.
which is
So
not it does.
this means that the SBA has now moved into a net operating loss in the first time since the financial crisis, and we have a government shutdown in progress now.
Right.
There's a whole host of reasons at this point. We're labeling this hopefully in the right category. This is the part that people miss. They think I'll just go and get an SBA loan when I'm ready to buy a business, but lending cycles change and your entire acquisition strategy should not depend on one source of capital. You don't control your ability to grow and to move when you do.
Right. And there's an entire derivative conversation we can have here about, is a down market the right time to buy? And by the way, my answer is yes. As a general rule, you have to be discerning and you have to be very careful in your diligence. But downward pressure on the market creates reduction in expectations of valuation, which means you can often get people out of a position they might not have been willing to give up short of a juicy premium a year ago.
Yes.
But you have to be creative, right? I know you and I have talked about how you built Uhuru, and you did it at a time when people weren't buying, and there were a whole lot of motivated sellers because they were looking at COVID and thinking, how do I de-risk my life, right?
And
Well,
it's the general black swan event, or the environment plays a critical role in driving motivation for people. And so
absolutely. But
I
it also dramatically impacts the financing environment, right? Which is
it
what we're seeing now.
yeah, it opens up the appetite for creative solutions. So a member in our Slack community asked the question saying, well, okay, well, how do I explain to the seller the benefit of not using an SBA loan for the deal and using more of a creative deal structure, like conventional bank debt, and where is this going to fit in? And so this is going to go to our next subject that I want to make sure we have time on, which is the very important part of a capital stack in doing deals, which is the seller note.
So
And let's talk about that form of debt.
yeah, so if we want to shift into discussion about seller financing, it works for a few reasons, and it's especially useful in a market like this one for related reasons, right? First, the seller has an informational advantage. Nobody knows their business better than they do. And so it's very much easier for them in a conservative lending environment, especially for them to get comfortable with a loan structure that's tied to the performance of an asset they know very well. Right. So that conversation is when you're looking at a situation where, the SBA is pulling back or a conventional bank doesn't have high appetite for lending, especially in the marketing and advertising
You say
agency.
it so nicely, Peter. For you, listener, when you don't qualify for a bank's money, when they don't want to give you money, yet you have a good opportunity in front of you, seller finance
Yeah.
that instrument is the thing you need to be tapping into.
Well, I have a gift for tactical understatement. So um, the the situation is such that in those environments, generalized economic contraction, global conflagration, lending pullback by critical agencies, government shutdowns, financing issues.
Intrinsic risks in the business as well.
I mean, that's just the exogenous risks, right? It's not even the intrinsic risks in the business. Then you talk about the intrinsic risks in the business. Yeah, that's the second reason why, in addition to the seller being able to more instinctively and at a fundamental level understand those risks and how it potentially impacts the payback of their seller note. It also, a seller note aligns incentives, right? Oftentimes that seller has a continuation function in the business. It may be as short as a transition services agreement for a certain period of time, or maybe that seller is going to be your head of department XYZ focusing on running that element of the business. However, we think about that. If the business performs, seller gets paid, which means the seller is extremely motivated to do this, right? It also allows them to, put a little extra interest in their pocket because in exchange for that flexibility, maybe they're getting a little more rate. Oftentimes I've heard sellers say, oh my gosh, that SBA lender wants 8.5%. That's ridiculous. I'll do this loan for 6. It's more than I can make by putting my money in the bank. And it's not as much as they're charging you. And so they think, hey, I'm double dipping. And they're not wrong, right? They're getting a 6% return on their money, and they get to watch the business that is responsible for paying it and make sure it's doing okay. The one challenge in this situation, of course, is that sellers often feel like this means that they kind of still own the business. It's important to make it's clear, unless they have an equity stake in the business, they're a lender and they're also an employee, and maybe they have an earnout or some other equity stake, but they're not in charge anymore. And
Right.
that is
They
something
have
where
an
you have
economic interest, not a
you're a stake
controlling interest.
they're a stakeholder, they're not the owner anymore. And that is an important thing. And the next thing, of course, it's worth mentioning is by reducing the need for external capital, you make the deal easier. You also can make the deal much faster.
Much faster.
Right. For any of you who have gone through the process of borrowing from a bank for a conventional mortgage, you can do it pretty quick, but there's a process and a series of hoops you have to jump through. For a business loan, that process is longer and there are many more hoops, right? And there's an entire underwriting and diligence function. You may require, depending on the lender or the third party capital provider, there may be a quality of earnings required, which you should probably get for yourself, but that's a separate issue. Either way, it's important. And it also allows you to play the middle ground between senior secured debt from a third party lender and straight equity where the person is a controlling shareholder.
And the other important bit is when uncertainty hits the business, which probability it will.
Yeah,
You can call up the founder of the business who understands it and say, I'm challenged with this. I need to make some modifications to the payments. I need you to work with me on this. Or how did you solve this? I need some help. And they're financially incentivized to help. The lender can only give you a little bit of relief.
right. And especially if they're, obviously the lender's not in the business. In a seller note situation, if they're in the business, maybe that their performance is part of the problem. It may be that, the business that you acquired from them is not running as well as it should. And you can essentially say, hey, yeah, I want to pay you. Let's fix this together. By the way, in the meantime, that provision we negotiated in this note about variability in the actual amortization schedule based on the performance of the underlying business, well, that's a provision we agreed to. And guess what? Your payments are being ratcheted down by whatever my decrease in cash flow was as a percentage.
And for the sellers to go, does that mean I'm not getting paid? That can still be a guaranteed amount. It's just deferred. It's made manageable for the business because you don't want to take down the business by its debt obligation to you.
Yeah, there's essentially, you would embed what we refer to as a forbearance element that says the note absorbs that variability in performance, right? I can't pay myself big distributions as a shareholder, but without paying you. But you agree that because the cash flow went down, your note goes down proportionally. Now you still earn interest on it. We may not change the term, although I've also seen notes where we do extend the term. So the principal amount doesn't change, the interest rate doesn't change, but the term changes and the amortization payment changes or goes away altogether for a period of time below a threshold. So that note is designed to absorb the variability in performance.
Yeah, and what I've seen in the best deals, especially in kind of programmatic M&A, you're a buyer looking to buy smaller businesses as add-ons to yours, is when the seller isn't just agreeing to carry the paper from a seller note perspective. It's where they actually prefer it because they believe in what they built and they rather participate in the upside rather than just take a check and walk away.
Well, I mean, conversationally, it's also a pretty compelling discussion, right? You say, hey, I want you to take a seller note. We agree we're going to take a seller note. And then you start negotiating the seller note and you talk about these terms and they're like, what's going on? And you say, I'm sorry, but do you not believe that the business is going to perform? Right. To some degree, it plays to the seller's ego, right? They can't aggressively attack the potential risk of the seller note paying without saying, hey, my business isn't worth what I just told you it was because of all these risks that you identified in the diligence process. And so the conversation dynamic reframes, right, on well, we've identified these diligence risks. You agree that they're diligence risks. You're going to take back paper. You're going to get paid before I do, but you have to be flexible on that. And you can't tell me no. At the same time, you say you want to hold the paper. So it's a way to triangulate the seller into a fundamental catch-22 conversationally. Now, most sellers are willing to take that risk because they believe in their business. The ones who don't are also a giant flashing diligence red flag that says maybe I shouldn't close this because there's something I don't know.
Yeah. And we, by the way, candidly, sold businesses where we've been paid a meaningful amount on close. That happens, and it's because we can prove that the business is going to be in the hands of the buyer in a way that is mitigating the risks that are very common in creating what we're describing as a balanced deal structure to mitigate those risks. And because to a seller, cash feels certain. But what's surprising is most sellers don't want cash. What they want is that feeling of certainty. Especially if you're not selling and just walking away, you're rolling forward. This really creates this opportunity for them to understand the certainty you can build. So you listed some of those provisions, some of the things that they can have as risk mitigations from the seller's perspective. But they can also, if you don't pay them, they can get the business back.
Well, it depends on how that collateral is structured. In general, they don't get the business back per se, but they can force a workout or they can force a situation where, as the lender, if you really truly fail to perform and the note defaults, they can run through a foreclosure process. Now, that doesn't mean that you toss them the keys and they get everything. What it means is that they're, again, when I talked about capital.
Listen to this really quickly because I gave the shorthand version of it. Peter's giving you the very detailed bit that goes in our purchase agreement. So just listen to this process. It's very important.
This is the turnaround and restructuring professional in me. I was a certified insolvency and restructuring advisor for the better part of my first career, if you will. And the important thing to understand here is that in a workout scenario, the lender doesn't come in and just take over and you get nothing, right?
No, there's notifications, there's cure periods, there's things in place.
In addition to all those, let's say that you blow through all those, you still haven't fixed the problem, and the lender has the opportunity to foreclose on the business. Worst case scenario happens, right? So they take the business, right? And I'm air quoting that for a reason because they don't actually take it. They take custody of it in order to monetize it, right? Their job is to turn around and sell it, and they have an obligation to all of the stakeholders in the capital stack to sell it for the best possible value they can get for it, which means they have an incentive to maximize the return. Now, it may be that the business really has underperformed, and so they don't get the X multiple you were hoping for on exit on a juicy, robust EBITDA that was 3 times what we bought it for, or 3 times what it was when we bought it 2 years ago. But in that scenario, again, we talked about who gets paid first, right? It's that senior secured stack that gets paid first, any subordinated debt stack instruments, whether that's junior or second lien or unsecured or a subordinated instrument. And then there's other parts of the equity stack. And if there's anything left over, though, after the bank is paid, or whatever that first lien seller note is, that first position debt instrument, that goes to the other stakeholders in order of the priority of their claims, which means the equity may still recover, but it's important to understand, you know, what is the threshold of recovery value, right? So you think about when you buy an asset, you don't just think about I'm paying 4 times for this asset. You're thinking about I'm paying 4 times for this asset with 2.5 times leverage, or with X senior secured leverage, X subordinated debt leverage, a half a turn of a hybrid equity instrument, and I put a half of 0.5x or half a turn of my own common equity in, or maybe it was rollover equity from the seller. But the point is, that's the order of payout. And so in a lender takes over scenario, you don't get a zero.
No,
You
you don't get a
get
donut. No. And from you buyers who are listening, there is an entire category of business buying, which is buying businesses out of insolvency, buying distressed businesses and businesses that have gone bankrupt. So there's a category of assets
several of them over my shoulder.
that is available to you. And it's really interesting if you've never really got exposure to that. So I do want to like reformat the capital stack for the listener. So in the option A that we were talking about, say we're buying a 1 million of EBITDA, 1 million of profit business. We go to the SBA. It's going to be a heavily weighted SBA. We're going to give the seller 80% cash on close. So the SBA is going to come into it. We're going to write an equity check in that. So it might be a 20% cash on close, 80% SBA, or 20% in the form of earnout performance, but they're going to get a meaningful amount. In option B, the way we're talking about creative structures, we're referring to there's a cash on close component. We're saying, ranges between 10 and 20%. A seller note. So the seller's holding a form of paper, and let's put it at 50%. And then you have a performance provision. And that performance provision can exist within the seller note, but we're talking about a real formal earnout, which is typically, it was created as a purchase price bridge. Whenever the seller wanted more for the business, what the buyer thought it was worth, they would do an earnout to help get them there to the valuation. And so if we have those, Peter, what do you think is the difference? Explain those two options for the listener who's going out and thinking those are the kind of basic structures of a capital stack that they can use and how they should consider that moving forward.
In 2 words, the difference between option A and option B is breathing room. In option A, the majority of the obligation is fixed, right? There's cash out the door on day one, and then you're paying a third-party lender an amount that is due without fail on the first of every month for the next 10 years. And now it's a 10-year term, so it's not a huge problem. What if you have a big market shock, right? Say COVID or 9/11, or we invade Iran and oil goes to $120 a barrel, and you have a business that's dependent on any of those things, or it exports, or it requires international air travel to function. Well, I had a client, you actually see them right over here. They were a poultry processor in Italy, and they had a 135 million euro bond due on the year that the bird flu hit Italy, and Italians stopped eating poultry. Literally, their revenue dropped 70% in a period of 3 months. In a year, they had 135 million euros due to their creditors. That deal was a restructuring, that one I pointed to. We did a very creative transaction, which incorporated things you might see in option B. No cash on close for that one, but we had a restructured debt obligation. We did an equity component to it where they got we did a rights offering and a publicly traded sub, and it issued all the equity to them. And I mentioned this because that entire deal was structured on the idea that our fixed obligations were lower. Portion of the purchase price was deferred or contingent on performance. And the guys who were the creditors, in this case, akin to the seller, they remained economically aligned, which is the same thing as option B here, right? Where you have a limited cash component or no cash component, a big chunk of seller note, which is deferred consideration or pushed off for a period of time, and a big chunk of earnout. To kind of bookend that comment from a risk-adjusted perspective, option B increases the likelihood of success by increasing the amount of breathing room you have.
Yeah.
With the various stakeholders in the group, and it aligns the stakeholders with the outcome you want to design.
Yeah. And again, to dress the table with us, we're referring to assets that are not worthy or do not qualify for excessive cash on close. We're talking about companies that are risky or have a lot of risk in them, and we're approaching a value creation in a way that's sensible and practical. So I want to talk briefly as we're getting to the end of this episode, and we'll have the next episode where we unpack even more in regards to structures. But I want to talk about how we're essentially replacing SBA, this high leverage debt instrument, with seller finance, and we're getting the rest of the way there as an earnout. That is the simple way of describing it. The last bit I'll say is, if we're trying to sell the business in the future, that juxtaposition is just so hard for people to make. So if you're listening to this as a programmatic buyer and you've used SBA before, you've acquired, you've paid down that loan, you've tapped into debt, you've had successful outcomes, but it might have been extremely stressful. And most people who have gotten SBA loans to go buy businesses label it very stressful. You do need to solve the business problems that exist, have the financial rigor, address the things that we've highlighted as risks that then get the corresponding deferred considerations, so you don't have this when you go to sell. So you've learned by being a buyer what to resolve when you're a seller. So therefore you can have the type of deal structure that maybe you're not handing out as a buyer today. So Peter, I'm going to ask you a question. Do you need more capital to buy a business?
No, you need to understand how to structure a transaction.
That's it.
Yeah. I mean, at the end of the day, these businesses, they're all designed, all these transactions are designed to help the business pay for itself, right? The nature of the leverage buyout, started in the 80s, right? KKR and Barbarians at the Gate and all that good stuff. It was borrowing a bunch of money to acquire a business and then using the cash flow of the business you acquired to pay back the money. That technology hasn't changed there's bells and whistles and other things about it, but that concept is the same, right? Business buying is the entire discipline of corporate finance is organized around the idea of the timing of cash flows. And
Well,
that's what M&A is. It's using the cash flows you can write a check, but it's not really an efficient use of capital. The entire idea here is other people's money helps you build your business, and you align incentives by giving them returns on their money. Seller notes are a way to do that.
Yep, seller notes are a great way to do that. It's one of the greatest rebrands in history. In the 80s and 90s, there was such a negative reputation associated with hostile takeovers, vulture capitalism, leveraged buyouts from these private equity firms. And then what they did, it wasn't just one company, it was an industry-wide pivot where leverage buyout firms, is what they were called, repositioned themselves as providers of operational expertise and growth capital, moving away from just financial engineering and leverage buyouts. And that's where you got the PE companies we have today. They are the same leverage buyout firms that we've had for many, many decades.
Yeah, you'll know Colbert Kravis Roberts, which was one of the players in the Barbarian at the Gate, the R.J. Reynolds buyout drama. They're still here. Henry Kravis still running that. Forsman Little was another one of those buyers. I actually helped sell one of Teddy Forsman's companies like 15 years ago.
Well, you already mentioned KKR, and then we also have Blackstone, right? They're the pioneers of these leverage buyouts.
Yeah, they've literally been around forever. The technology hasn't changed. It's just the branding. Now, I will say one of the differences is that so many of the things that, those corporate raider tropes, which were not wrong, from the 1980s was also linked to the fact that so many companies for the 100 years prior were conglomerates, right? They were amalgamations of large, different, disparate businesses with big chunks of highly inefficient, stuff stapled together and bound together with duct tape and chicken wire to build these enormous enterprises over time. And, oftentimes they also had overfunded pensions, which, if you've ever seen Wall Street and seen Michael Douglas's huge rant about, the golden goose here is the overfunded pension when he talks about Blue Star Airlines, that was real. businesses today don't have those assets. They typically tend to be more pure play, right? You don't get a conglomerate that is 11 different things unless you're looking at General Electric, which is a million different things. But so many businesses these days are a pure play on a single asset. And so private equity, when they make those investments, they specialize. I was the CFO of a private equity held medical device company. All that private equity investor did was invest in the healthcare sector. That was their pure area of expertise. They had guys who used to be CEOs of publicly traded healthcare companies who were their operational, expertise boards, who got inserted in all these things and put on the boards and helped. And so, I mean, there is value that can be created in private equity, but the real takeaway for an agency owner is whether you like that whole world or despise it, there's value to be taken from the technology they employ in their work,
Yeah,
right?
100%.
They believe in the use of experts and subject matter experts to help them do the things that they do. They're willing to pay for them. They're willing to deploy them to their boards and use them as advisors. And you know that, and they're used to taking that expertise and leveraging it into buying companies to create value, and they work to build the financial capital stack, the deal structure that enables them to do that. And what you and I have done in so many transactions together over the last 4 or 5 years is help people in the agency space do the same thing at a smaller scale to build and scale their businesses in ways that make sense for them, to get them flexibility and breathing room to build a business without having to go mortgage your house and take out a life insurance policy that pays off the loan if the tragic happens, and to build the flexibility into a deal structure so that you don't have to have absolutely perfect execution at a razor's edge and not take out a penny from the company for 5 years in the hope that you can pay off that loan that is bleeding you dry every month. And so this kind of technology is easily designed into these situations. And we haven't, I presume we're going to have another conversation about this, but there's other elements in the capital stack that I like to use even more than seller notes.
We will get to it. This was episode 1, which was about understanding SBA and understanding the very general capital stack. In the next episode, we are going to unpack what happens when capital becomes constrained and we need other creative deal structuring replacements for debt. And that is going to be where some of our best mechanisms, instruments, provisions are spelled out. Stay tuned for the next episode. Make sure you subscribe to the Agency Acquisitions and Exits podcast. Episode 2 will follow this episode the next week. Peter, by the time they hear this, they'll be listening to us again. Thank you, my friend, and I will see you on episode 2.
Great. I look forward to it.
If you like this episode, probably like one of our other episodes. Click here.